Hey everyone, me Kevin here. In this video, we're going to talk about CPI expectations as well as expectations for the Federal Reserve's action at the beginning of November, which I believe is pretty much going to get nailed this week as we lose our last remaining negative catalyst for the market. That's right, this Wednesday at 5:30 a.m. Pacific time, which I will be live streaming, we will get the consumer price index inflation readings. This is the last negative catalyst that we have for this year. That is, of course, following the drama around the debt ceiling, the inflation, or the infrastructure package, the budget. All of these things, of course, kick down to the road to December, which means there'll be plenty of time to get these things handled because the infrastructure packages will be passed before debt ceiling issues and the budget come up again. Those are going to be nominal, benign catalysts before the holidays. The lawmakers will pass these. It'll be an eye roller if there's any kind of delay. But the Evergrande crisis, look, it is still a crisis, but contagion fears have really evaporated. And fears of the Federal Reserve tapering have really evaporated as well because we already have the time frame. We know that the Federal Reserve believes they're going to start tapering at the beginning of November and finish their taper by the summer. So what I want to talk about now, though, is I would just briefly want to start by touching on the jobs report, some more detail of what happened around this and is it really as bad as it seemed. Then we're going to talk a little bit about inflation and yeah, we'll take it from there. But I got to take a bite of this because, wow. All right. So, don't worry. Oh yeah, jobs. So here's the thing. The jobs data has the potential of throwing a wrench in the pace of the taper, in my opinion, with the Federal Reserve. So that means that even though the market was anticipating the Fed would taper the beginning of November, which I still think will happen, the market was anticipating the Fed would continue to taper all the way until about the summer and then raise rates at the second half of 2022. This jobs report, and if we continue to get weak jobs reports like this, which I'm going to delve into why these jobs reports are coming in so poorly, it is very possible that we're going to extend tapering to a normal 12-month taper cycle. Because usually, historically, we've tapered over 12 months. And the current trajectory is about 9 months. And I think the Fed's going to update this back to 12 months, which means we could be tapering throughout the entire 2022 year, which means potentially no rate increase in 2022, which is, I think, very good for markets and also good for real estate. Real estate is not going to like interest rates going up at all. Now, I'm the idiot who's still buying, but I also keep finding good deals, so that's just what I do. But anyway, so jobs data. So the biggest issue with the jobs data is low labor force participation. This is something that we're seeing. We're filming a video right now, but it's a Pokemon event. Yeah, all right. So low labor force participation is the biggest issue. And this is something that before the recession was 63.4%. Now we're at a level of about 61.6%. That's down from 61.7% last month. Now, why does that matter? Well, it matters because as less people go back, because it sounds like, oh, come on, that's just 1 or 2%. But think, 1 or 2%, 1% of our labor force is like 1.5 million people, which could be 100,000 extra jobs, give or take, every single month, every single time we get a labor report. So it's a big deal, that labor force participation rate. And one of the reasons it's down is not this stupid helicopter, but one of the reasons it's down is because we're seeing a lot of, or a seasonally adjusted loss in how many women and men are applying for educational jobs, but we know those are mostly women, disproportionately women. And that's potentially because of not just COVID fears, but probably mostly because of childcare issues. That is, a lot of children aren't able to get the vaccine, so you have a lot of people who are fearful of COVID who don't want the vaccine, aren't sending their kids to school or taking care of their children at schools, or not sending their kids to schools or taking care of them at home, which means now all of a sudden there are less women who can fulfill those jobs, who would ordinarily be taking those jobs. But also, those who do want to take the vaccine can't give the vaccine yet to children because we're not approved yet. Now, we do think we're going to get Pfizer approval for 5 to 11-year-olds soon, which is good. But this ended up being a big hit to this last labor report. Private sector labor jobs, the increase in the private sector labor was still very good, still strongly on pace with expectations. This is why the last Wednesday ADP report for private sector jobs came in very strong, but the actual government labor report came in so weak. That's because we included the educational losses and the lack of of workers we saw in the sector. So there is right now a lot of demand for workers, but again, we're seeing a lot of people stand on the sidelines despite the fact, and this is against expectations, despite the fact that the unemployment boost is over, right? In September, the unemployment boost went away, and we thought a lot more people would go back to work. So this was a big negative surprise. And Delta's not as big of a fear now as it used to be, so we thought more people would go back to work. So it was a little bit of a negative shocker. And this has a lot of people believing that the Federal Reserve is going to not delay the taper, but extend the taper. That way politically, even though they're supposed to be apolitical, but we know that's full of crap, we know that politically the Federal Reserve is going to then be able to say, hey, we're tapering. We're just going to take longer doing it. That's my expectation. But I think really the big nail in the coffin here is going to be what happens with the CPI report. So this Wednesday, we get CPI that comes out. And CPI is going to come out. We're expecting a CPI to come out at a 0.3% increase month over month. 0.2% once we take out food and energy. 0.3%, by the way, is an annualized 3.6%, which is good. We really want to pay attention to that month over month number. Year over year is going to come in still probably scary. The expectation is 5.3%. That's high. This is that clickbait inflation we talked about as early as November of last year. On my channel, we've regularly talked about how we are going to get this insane clickbait inflation figures. And the reality is they're not really clickbait. They are very high. But we do expect at some point them to inflect down. We thought they would inflect down at the end of this year. They still might. This October report is going to be inflation for September. So my talk about September and October, my original expectation was we would see a downward inflection in inflation September and October. Reports come out October, November. So I could still be right, but I'm already softening my position, not to flip-flop, but because I'm reading the data and I have a fluid state mind. I'm willing to adjust if data is coming in worse, and we're seeing data come in worse. Commodity prices, we thought they would come back down. They're inflecting back up, like lumber and oil inflecting back up, used car prices inflecting back up. The labor shortage isn't abating as quickly as we thought. So there are a lot of things that reiterate why we're going to see this temporary inflation longer and larger than expected. So I think market-wise, we're expecting a 0.3% month-over-month read. If that comes in at less, that's going to be wonderful. I mean, ideally, that's where we see the inflection point. Is not in the headline number. It's going to be the month-over-month data. Ideally, we see something, honestly, if we saw something like 0.1, oh my gosh, I think tech stocks would rally, the market would rally, it'd be great. Potential negative catalyst for crypto, though, because I do think about 50% of crypto investors are deathly fearful of inflation. And that is based on surveys that I've done on my channel and just other research. My channel, I think, could be a little skewed, though, so I have to keep that in mind as well. If we end up getting a surprise to the upside on inflation, it's not going to be good. Treasury yields already right now sitting at 1.62%. We're heading to that 1.75, basically the highs that we saw around February. March was not a good time for the tech sector at all. Now, I'm still staying strong on believing that the best way to get through this disaster is to buy real estate, to hedge yourself with real estate. That way you're locking in low interest rates, and that way even if prices fluctuate, it's cheaper for you to pay off that long 30-year fixed rate debt over time. And then take advantage of being able to buy dips on supply chain challenge stocks as well as tech stocks. So supply chain challenge stocks would be things like Shift, the used car company, Enphase, anyone who has to deal with chips, a lot of the automakers, Neo, even Xpeng, but that also includes a China risk, so you have to consider that. But even honestly, I already mentioned Enphase, but Tesla to some degree is held back substantially, especially with the new product launches by some of these shortages. So I actually did buy, and I rarely do this, especially since I'm pretty anti-buying calls right now. I actually did buy a call on Tesla, which, remember, if you want to know all of my trades, why I do them, join the Stocks and Psychology of Money program, link down below, and get that 41% off coupon code Diamond Hands. So look, if we end up getting a beat on inflation, it's gonna be bad. Nobody's gonna be happy about that. Month over month number comes in at like a 0.5, 0.6, 0.7. Bad day for the market's not gonna be very happy about that. Imagine we get a 0.7 or something like that. Now you're talking like an 8.4% annualized inflation. That would be horrible. It'd be such a horrible miss. The market, I think, would plummet, and you'd have a really nice buy the dip opportunity there. But then you'd also want to go through the data to see what went up, and that's very important as well, which is something we're going to do, because if what went up was something like women's dresses and used cars, which is something we've seen in the past, okay, big deal. But if things that are going up are rent and services, That's going to be more long lasting. That's going to be more structural, and structural inflation lasts longer. Whereas, like, again, used cars, dresses, those things are temporary. But rents, services, wages, those are a problem. And we've already seen wage-based inflation come in a little tick higher in this last labor report that came out on Friday. So long and short of it, if we get a big dip, which is very possible based on this ticker, I'm going to buy. And I think a lot of folks are going to buy that dip. We know that the repo markets are so full of cash. That's because so many institutions have so much cash, they don't even know what to do with it. And if we get a big dip, the banks will step in and start buying this dip. That's my belief, and I actually think that's something that's going to keep the S&P really from falling more than 10%. I could be wrong. In some sense, I kind of hope I am, because then again, we get a nice little shopping spree, but I'm not keeping as much cash on the sidelines as I had before this September dip, because I spend most of my cash on the September dip. So anyway, if you like this kind of content, subscribe. I'm going to get back to this Pokemon event. We'll see you next one. Thanks. Bye.